Hello and welcome to our presentation. Today we are going to discuss tax transparency measures aimed at discouraging multinational tax avoidance in Australian companies. Many multinational corporations, both inside and outside of Australia, reduce their global tax burdens by shifting profits from high tax countries to low tax jurisdictions through transfer pricing strategies. This involves setting internal prices for goods or services traded between subsidiaries in different countries to allow profits to be recorded in the lower tax jurisdictions. A recent example of this strategy can be seen in the investment banking firm Macquarie Group Limited. In their 2025 annual report's consolidated entity disclosure statement, Macquarie disclosed over 1,000 foreign subsidiaries. Within this, 154 were found to be located in jurisdictions reputable as offshore tax havens, with the most notable visualized in the table. Additionally, a further 404 subsidiaries did not report any tax residency as a result of being incorporated in jurisdictions without corporate tax regimes. These reports raised serious concerns about the group's international tax arrangement, both structurally and in regards to their transparency. In their annual report's notes, Macquarie also states that in offshore jurisdictions, they follow local tax consolidated rules, which may allow subsidiaries to access and use the tax losses or reduce the tax rates. In the 2025 financial year alone, the group reported a 372 million benefit from rate differentials on offshore income, suggesting profits may have been shifted from high tax to low tax countries. Whilst the group claims it uses advanced pricing arrangements to manage transfer pricing risks, it does not disclose how many are bilateral versus unilateral. This is of significance as unilateral APAs still leave room for profit shifting. Overall, these findings show how Macquarie Group Limited and other multinational firms can legally lower their tax burdens through the use of foreign subsidiaries and transfer pricing, particularly in jurisdictions with limited transparency.
As Elio presented, Macquarie's case highlights the value of public disclosure tools like Consolidated Entity Disclosure Statements, also referred to as SEDS. SEDS were introduced in Australia in July 2023 under the Corporations Act 2001 and became enforceable from the 30th of June 2024, requiring public multinational Australian companies to prepare a reporting and audit summary in their financial statements that discloses their corporate tax structure for subsidiaries, regardless of size, materiality, or whether they are listed or unlisted public company, as visualized here. One of the significant components of the SEDS disclosure that works in favour of discouraging tax avoidance is their expectation for auditors to provide views without regard to materiality. In accordance with corporate social responsibility measures and accounting standards, this accounting concept of materiality is heavily dependent upon the nature or circumstances, and in particular its scale or magnitude. Before SEDS were introduced, this meant that if items were minor enough or, according to the AASB, did not influence the economic decisions users would make on the basis of their financial statements, they could be considered immaterial and omitted without any mention in the financial statements or supporting notes. This previously enabled firms to hide offshore tax havens more easily under the justification of certain subsidiaries having no material, significant assets or revenue streams to be reporting in the benefit of shareholder and market decisions. By forcing these companies to disclose both direct and indirect subsidiaries, regardless of materiality, removes their ability to omit small or dormant newly acquired shelf companies and offshore subsidiaries from their financial statements as a form of tax avoidance. Another improvement SEDS offer in increasing Australian tax transparency is their public nature. Previously, the only systematic written disclosure of tax havens for significant global entities was in country-by-country reporting, an internal report for companies earning revenue greater than $1 billion to the Australian Taxation Office aimed at combating tax avoidance. These documents, however, are kept confidential between the company and tax authorities, and information is aggregated by country rather than by subsidiary. SEDS alternatively are administered by ASIC as part of audited financial statements and are publicly available to anyone in their financial reports and is required by all public companies, no matter how large or small. The public nature of SEDS enhances transparency into hidden tax structures and has the potential to discourage tax avoidance due to heightened risk of reputational damage and regulatory reprimands. For these reasons, the incorporation of SEDS in all public companies' financial statements offer greater corporate transparency, fairness, and accessibility, and should help to further discourage the use of tax avoidance strategies going forward.
Building on Ella's discussion of how CEDs enhances transparency and accountability, we now turn to a broader proposal that involves taxing corporations at the consolidated group level, which could further discourage multinational tax avoidance. Taxing corporations at the consolidated group level is an effective way to reduce multinational tax avoidance. Under the current entity-based system, each legal subsidiary is taxed separately. This allows multinational enterprises to shift profits from high-tax jurisdictions to low-tax or no-tax jurisdictions through practice such as transfer pricing. Related entity can artificially manipulate the pricing of intra-group transactions to allocate profits in tax havens. Group-level taxations remove the incentive for such manipulation. When the entire multinational group is treated as a single taxpayer, intra-group transactions are disregarded for tax purposes. This means shifting profits across borders no longer changes the group's total tax burden, thereby eliminating the financial benefits of profits shifting. From a regulator perspective, the current entity-level system limits tax audits to local subsidiaries, making it harder to detect profits shifting cross-border, especially under opaque arrangements like unilateral APS. However, the consolidated tax approach enables authorities to overcome many of these technical and administrative barriers by treating the multinational group as a single economic unit. Regulators no longer need to audit each intra-group transactions or determine this arm's-length price in every case. Instead, they can access global profits and assign taxing rates using simpler, transparent formulas. This approach makes enforcement more feasible, reduces administrative costs, and leads the effectiveness of artificial structures used to erode tax bases.
Overall, the incorporation and updating of more stringent measures surrounding tax frameworks, including consolidated entity disclosures and enhanced global reporting standards, is expected to help reduce the number of companies engaging in transfer pricing and other aggressive tax avoidance. By closing loopholes and opening companies to public critique on hidden structures, both deters engagement in these practices and will help take steps towards a fair, transparent, and accessible global tax environment going forward.